Exactly what's driving this market sell-off today, and it's not just the major indices that are down. As we mentioned, gold and silver, copper also trading down, and the energy complex in its entirety trading lower, along with platinum, palladium. So it's very hard to find a haven here. Is today's sell-off the beginning of a correction many analysts have been calling for, or really just some air coming out of a very filled balloon? Joining me now to discuss it, Ben Willis down on the floor of the New York Stock Exchange, Charlie Nidos at the CME, Barry James Advantage Fund CEO and President. He's here with me in studio, smiling because he's been saying for weeks, go into bonds. And Marc Faber, Gloom, Boom, and Doom Report author, Big Bear, joining us by phone from Zurich. I want to begin with Ben Willis. Please tell me what the traders believe triggered this sell-off.
Well, I'm a little concerned that you talk about letting the air out of a big balloon and then come to me, but, I'll try and get over that. Okay. But at this point, I think what basically you need to view this day, it's the last day of the month, and you're seeing an asset allocation managers hitting the reset button. That's why you're seeing gold under pressure. So you're not seeing fear in a marketplace because you'd see more of a flight to the precious metals.
Okay, hold on. So you're saying
sure.
that at the root of this, it's window dressing by hedge fund and mutual fund managers. Just
profit taking, right? I'm one of those people who's been looking for a correction. We've been seeing it for the last months in a sector rotation in correction, if you will. It started in the biotechnology stocks and the social media stocks. Then the last few days, we've actually been seeing some money come off the table in the chip stocks. That was some pretty smart money considering what happened to Micron today. But the numbers themselves coming in, I believe, is a follow-through of the market trying to price prosperity, meaning a 4% GDP and a 0.7% increase in the employment cost indice is an indication of good. That means the market is healthy, the world economy is recovering, and you need to be in stocks. The sell-off that you're seeing happen right now is a function of asset allocation models not sure where to go because they're losing the safety of the bond market. You saw the bond yields trade way above the 2.6 level. They've come off somewhat, again, as the asset allocation model moves into the bond market today, but not dramatically. I mean, the numbers haven't moved that much. So you're seeing, I believe, a reset. And tomorrow, the first day of the month, I think should prove very interesting. Will the sector rotation continue? I believe so. Is it a global market correction? I doubt it.
All right. Let me just mention that the 30-year, if you can't tell from that chart, is at 3.32%. Charlie Nidos, to you in the pits, do you believe in Chicago that what Ben is saying is correct? There's still very much a stronger foundation underneath what is, well, let's call it what it is, a 1 to 2% sell-off. I wouldn't exactly jump off, the roof on something like this.
No, but to me, we're at key technical levels here. The Russell is breaching the 200-day moving average today here, and the S&Ps are taking out the 50-day moving average. That being said, the 50-day, if this year you would have bought that line every time, that was a great place. That's contained most of the breaks. You've only had a few closes underneath there. What's a little concerning to me today is good news is bad news and bad news is bad news. By that I mean the weekly claims here was a very positive number.
Very
if you looked at the revision, it was a great number. On the flip side of that, boy, the Chicago PMI number was just a huge surprise and a big black eye. I think tomorrow, he is very right that tomorrow's close is going to be very key in the sense we'll get the national ISM number. If that mirrors the Chicago number here, look out, there could be some more downside below.
And the July jobs report, let's not forget that. And we bring into the conversation Marc Faber of the Gloom, Boom, and Doom Report. Mark, when you see this kind of sell-off, what is your next thought? You who had said 20% correction coming.
Well, we don't know whether this is the beginning or whether there's one more rally to come, but I would say stocks in the U.S. are no longer good value, period. They are overbought. The sentiment, if you compare to, say, March 2009, when there were so many people calling for the S&P to drop to 400, and everybody was bearish, and today 99% of investors are bullish. I think just from the technical point of view, when you look at the market action since the beginning of the year, with all the hoopla hoop, some of the media told the public, not necessarily Fox News, because Fox News is relatively objective, the Dow is up less than 1%. The Russell 2000 is down as of today 3% and down 7% in 1 month.
Right.
So there has been a lot of technical damage. You look at Yum. Yum was one of the favorite stocks. You look at GE, at General Motors. All these stocks have sold off a lot.
Let
you
me
look
just
at
say, Yum Brands down about 5% right now. General Electric down about 1 2/3%. Stay there, Mark. I want to bring in Barry James because he may be a compatriot of yours in certain respects, because he's been saying, for how long have you been saying, please get into treasuries, at a time when people were saying the exact opposite?
This spring. Yeah, we said to start selling. You know, there's a couple things going on when it comes to the marketplace. One is that we've had this 800 days of advance with no 10% correction, and that kind of sets us up for a correction.
Yeah, by the way, that takes us back to December of 2011. It's
exactly.
a long time without a correction.
It is. The other thing that's happening, of course, is the Federal Reserve is changing gears. We've gone through the tapering. We're down to $25 billion a month. And what we find with that is during quantitative easing, the stock market rose at over a 20% rate. When they've stopped quantitative easing since 2008, the market's fallen at a 20% annualized rate. So it's finally starting to seep into people's psyche that, hey, the punch bowl's being taken away.
But they weren't there anyway. And I know Ben Willis right now is stamping his feet. I'm not equating you to a horse or a bubble. Okay, but I know you want in on this to simply say you're not exactly the most cheerleading of people out there. But why are Barry and Mark wrong in your opinion?
Because the backdrop to all this is where we've come from, and the fact of the matter is what we need to watch now is an art form of the central banks throughout the world and how they will remanipulate their currencies from the race to the bottom to the appreciation. I believe a great deal of the override of today was in fact repricing of the U.S. dollar into an uptrend against the other major currencies, particularly the euro. That being said, it is still a matter of fact, a 4% GDP is a positive number. It tells you the world is improving, and there is no reason for the Fed to manipulate interest rates at a 4% GDP. You can't have a 3.3% bond and a 4% GDP.
Marc Faber, we just showed currencies, and nearly all of them are lower against the U.S. dollar. What's your counter-argument to what Ben is saying?
I have no counter-argument. In fact, I agree. Dollar strength is a symptom of tightening international liquidity and has been in the last, say, 10 years, stock unfriendly. In other words, you want to get the stock market up, you have to print money, and then dollar weakens and stocks go up. But when you kind of have a tightening as we have now, usually it's dollar friendly, but unfriendly for stocks. But I would also add to it, because before somebody on Fox said everything is down today. Well, that is not entirely true. The bonds are acting reasonably well. And the bonds market doesn't buy entirely this 4% GDP growth figure. And I'd like to say that if you look at the announcements of Caterpillar Tractor and other companies, international sales, especially coming out of emerging markets, are very weak. That tells you the world is not healing, but actually going back probably into recession.
Well, it may surprise you.
Why have you increased your exposure in the Chinese market against the U.S. market?
Because it's a market that may be not correlated with the United States. It's a market that has performed horribly. But I also pointed out in my recent report, if the U.S. market sells off strongly, everything will go down, but maybe Chinese stocks and Hong Kong shares less than U.S. stocks.
Well, it's not the worst year-to-date picture for the FXI, which is the iShares China Large Cap Fund. We thank all of you for joining in. And the one thing that I didn't hear, and I know there's more to talk about with Argentina, is that it's not necessarily at the heart of what's bringing this sell-off to pass. We want to thank everybody. Ben Willis, Charlie Nidas, Marc Faber. We are going to keep Barry James around because he's got $5 billion in assets under management. I can't kick him off the set. But